Two co-workers sit in the same open-plan office. Same company, same job title, same base salary of about $95,000 a year. One of them, a guy named James, drives a 3-year-old SUV with 70,000 miles on it, packs his lunch most days, and lives in a modest 3-bedroom in a suburb where the yards aren't huge, but the school ratings are decent. The other, a woman named Danielle, leases a new crossover every 2 years, orders lunch from an app 4 days a week, and rents a renovated 2-bedroom closer to the city because she likes the energy of the neighborhood, and her kids' daycare is right around the corner. If you looked at their bank accounts on the first of the month, you'd see nearly identical direct deposits. But if you looked on the 28th, you would see two completely different financial realities. James usually has somewhere between $1,200 and $2,000 still sitting in checking before the next paycheck lands. Danielle is often under $300, sometimes dipping into a credit line she opened just in case about a year ago. Now here's the part that matters. Both of them have read the same personal finance books. Both of them follow some of the same creators online. Both of them have heard the advice to save 6 months of expenses, invest early and often, and avoid high-interest debt. And both of them feel like that advice is talking past them. James thinks the advice is too aggressive, because after the mortgage, the car insurance, the groceries, the kids' after-school programs, the utility bills that seem to climb every single quarter, and the property tax that went up again this year, saving 6 months of expenses feels like it would take 6 years. Danielle thinks the advice is too simplistic because her situation has layers. Daycare alone runs over $1,500 a month. Her student loans restarted, and she's carrying a balance on one card from when her car needed new brakes and she didn't have the cash. Neither of them is being reckless. Neither of them is uneducated about money. And that's exactly the point. There is an income level where financial advice quietly stops being useful. Not because the advice is wrong, but because it was never really built for the place where most people actually lived. Think about the financial guidance that dominates the internet, the bestsellers, the podcasts, the short-form clips. Almost all of it falls into one of two buckets. The first bucket is survival advice: how to get out of debt, how to stop living paycheck to paycheck, how to build your first emergency fund from zero. This advice is aimed at someone who is clearly underwater and needs a lifeline. It's direct, urgent, and motivational. The second bucket is optimization advice: how to max out your retirement accounts, how to allocate across asset classes, how to use tax-advantaged vehicles to shelter income. This advice is aimed at someone who already has breathing room and needs to make smarter moves with their surplus. But between those two buckets is a vast middle ground. Households earning somewhere between $60,000 and $150,000, where neither bucket fully applies. You're not drowning, so the survival advice feels patronizing. But you're not swimming freely either, so the optimization advice feels aspirational at best and irrelevant at worst. You are treading water in a zone where every dollar has already been mentally assigned before it arrives. And what makes this zone so tricky is not just the math, it is the psychology. When you earn enough to technically afford most individual expenses, but not enough to afford all of them simultaneously without tension, something strange happens to your decision-making. Behavioral economists describe a phenomenon called present bias, the tendency to overvalue what's right in front of you and discount what's down the road. And present bias doesn't hit hardest when you're broke. It hits hardest when you have just enough room to say yes to things. When a household is earning $30,000, There's no decision to make about upgrading the phone plan or signing the kids up for travel soccer. The answer is already no. But at 90,000, those decisions become real. And every single one of them feels affordable in isolation. A better phone plan is only $20 more a month. Travel soccer is only $150 a quarter. The meal kit delivery replaces a grocery trip and saves you time, so it feels like a wash even though it costs 40% more. A streaming service here, a cloud storage upgrade there, a slightly nicer apartment when the lease renews because the new one has in-unit laundry, and wouldn't that save money on the laundromat? Each choice is rational on its own. But stacked together across 12 months, they form a slow, invisible escalator that lifts your cost of living right up to the edge of your income. And that's before the truly uncontrollable expenses show up. The insurance premium that jumped 11% at renewal, the HOA special assessment for a new roof, the out-of-pocket dental work that your plan only covered at 60%. This is the mechanism that most financial advice doesn't address. Because most financial advice assumes your expenses are either fixed or foolish. In the survival bucket, you're told to slash expenses ruthlessly. In the optimization bucket, you're told your expenses are already handled, so focus on growth. But in the middle, your expenses are neither reckless nor easily reducible. They are the accumulated rate of 100 small, reasonable commitments that now define your baseline. And your baseline is sitting right at the borderline. Research from a well-known Goldman Sachs retirement survey found that even among households earning over $300,000 a year, roughly 40% reported living paycheck to paycheck, largely because of lifestyle creep and competing financial priorities. If that's happening at 300,000, imagine what it looks like at 90. The Federal Reserve's surveys on household economics frequently report that a significant share of adults couldn't cover a modest, unexpected expense without borrowing or selling something. And these aren't just low-income households. A growing portion of middle and upper-middle income families fall into this category, because their fixed obligations have expanded to absorb nearly everything they bring in. The personal savings rate in the United States has hovered around 4 to 5% of disposable income in recent years, which means the average household is keeping pennies on the dollar after everything else is paid for. And that's the average. Many families in this middle zone are saving less than that, or nothing at all, not because they don't want to, but because the monthly math simply doesn't leave enough room. There's another layer here that rarely gets talked about, and it's the social infrastructure of spending. When you're in this middle income band, you're surrounded by people in roughly the same boat, and the boat has an unspoken dress code. You attend a birthday party, and it's expected you'll bring a gift in the $30 to $50 range. You get invited to a group dinner, and the bill gets split evenly, even though you ordered the cheapest thing on the menu. Your kid's school asks for donations for the auction, the field trip, the teacher appreciation week, and each one is small enough that saying no feels disproportionately awkward. You notice the neighbor hired a lawn service, and suddenly your Saturday morning mowing routine feels like it's broadcasting that you can't afford to outsource it. None of this is vanity. It's the texture of daily life in a community where everyone is trying to maintain a standard that costs slightly more than they can comfortably afford. Behavioral scientists sometimes call this social comparison or reference group spending. You don't benchmark your lifestyle against the national average. You benchmark it against the people you see every day, your street, your office, your kid's school drop-off line. And those people are all doing the same thing, quietly stretching. So here's the question that actually matters. If the advice isn't built for this income level, what is? I've noticed that the people who seem to navigate this zone well don't rely on willpower or discipline in the way most advice suggests. They don't white-knuckle their way through each month resisting temptations. Instead, they build quiet systems that remove decisions from the equation before the month even starts. And that distinction, systems over willpower, is really the whole game at this income level. Let me explain what that looks like in practice, because it needs to be specific or it's just another vague suggestion. The first thing is that money needs to move before you see it. The day your paycheck lands, automated transfers should pull a fixed amount into a separate savings account and, if possible, into a retirement contribution that comes out pre-tax. The amount doesn't need to be impressive. It needs to be consistent. If it's $50 a paycheck, that's fine. If it's $200, even better. But the non-negotiable part is that it happens automatically, without a decision, without, let me see how this month looks first. Because the moment you give yourself the option to evaluate, present bias will find a perfectly logical reason to skip it. The research on this is clear. When savings are automatic, participation rates and balances increase dramatically. When savings require an active choice each month, most people eventually stop choosing it. The second piece is something I think about a lot as a family guy. You have to separate your spending into what's truly fixed, what's flexible, and what's invisible. Fixed costs are the mortgage or rent, the car payment, insurance, the minimum loan payments. These don't change month to month, and they're not worth agonizing over in the short term. They can only be addressed through bigger structural decisions like refinancing, moving, or changing coverage. Flexible costs are groceries, gas, dining, entertainment, kids' activities. These are where your actual daily choices live, and they're worth tracking, not obsessively, but honestly. Most households I've seen have between $300 and $800 a month in flexible spending they genuinely cannot account for when they try. It just leaks, not through big purchases, through the accumulation of tapping reorder on the same delivery app without checking if the price went up, through grabbing coffee and a breakfast sandwich 5 mornings a week at $4 or $5 a pop, through adding items to the online cart because you've already hit the free shipping threshold, through keeping subscriptions running on 3 or 4 platforms you rotate between but never cancel. Then there are invisible costs, the ones you set up once and never revisited. The insurance rate you haven't shopped in 3 years. The cloud storage tier you upgraded during a project and forgot about. The credit card annual fee on a card you no longer use for its perks. The old retirement account sitting with a previous employer's plan invested in a default target date fund you never chose. These invisible costs are where the middle-income household bleeds the most. Not because any single one is large, but because they compound in silence. When you're supporting a family and juggling everything that comes with that, the idea of sitting down and auditing every line item sounds exhausting. And it is, if you try to do it all at once. That's why the most realistic approach works in tiers. This week, The only task is to open your bank statement or your banking app and look at the last 30 days of transactions. Don't judge them. Don't cut anything yet. Just look. Notice where the money went. Most people who do this for the first time in a while find at least one recurring charge they forgot about and at least one spending pattern that surprises them. Not shocks them, just mildly surprises them. That awareness alone shifts something. This month, pick one invisible cost and address it. Just one. Cancel the subscription you haven't used in 60 days. Call your auto insurance and ask for a rate review. Roll that old retirement account into an IRA so it's actually in your line of sight. Move one thing from the invisible column into the visible column. That's the whole month's assignment. Over the next year, build toward a structure where your savings are automated, your flexible spending has a rough weekly boundary you're aware of, even if you don't track it to the penny, and you've reviewed every recurring charge at least once. If you do those three things, automate savings, set a loose weekly spending awareness, and audit recurring charges, you will have done more for your household's financial position than reading 10 books about investing ever could. Because at this income level, the problem was never information. It was implementation in the middle of a life that never stops demanding your attention and your money at the same time. There's something else worth saying here, and it's about the emotional weight of all this. When you're in the middle, you feel like you should be doing better. That's the particular cruelty of this income zone. You earn enough that struggling feels like a personal failure. You look at the advice that says you should have 6 months of expenses saved, and a maxed out retirement account, and a 529 plan for each kid, and you feel behind. You feel like you're doing something wrong. But the truth is that the system was not designed with your situation as the primary use case. Tax policy, financial products, employer benefits, they all tend to reward either the very disciplined high earner or provide safety nets for the lowest earners. The middle is where the complexity is highest and the margin for error is thinnest. Knowing that doesn't fix anything by itself, but it does something important. It takes the shame out of the equation. And when you remove shame, you make room for clear thinking. And clear thinking is the only thing that actually leads to better decisions. Now think about James and Danielle again. A year from now, their salaries are still basically the same. James didn't get a huge raise, and Danielle didn't come in to some windfall. But James spent one weekend in January looking at his recurring charges and found $140 a month in things he'd forgotten about or didn't use. An old cloud storage plan, a second music streaming account his teenager had signed up for on his card, and a roadside assistance add-on that duplicated what his insurance already covered. He canceled all three, set up an automatic transfer of $150 per paycheck into a high-yield savings account, and stopped looking at it. By December, without ever feeling a pinch, he's sitting on close to $4,000 in that account. It's not life-changing, but the first time his water heater broke and the repair was $1,100, he paid it from savings and went to bed that night without a single knot in his stomach. Danielle, after hearing James mention what he'd done at lunch one day, did something similar but started smaller. $75 per paycheck, automatic, into a separate account she named Do Not Touch. She also called her car insurance company for the first time in 4 years, and they found her a plan that was $60 a month cheaper. She used part of that gap to bump her 401k contribution up by 1%. she didn't feel like she'd transformed her finances. But by October, she had almost $2,000 in that account, and her retirement projection had shifted forward by nearly a year. Neither of them followed a guru's playbook. Neither of them made dramatic sacrifices. They built small, boring, automatic structures into a life that was already full. And those structures did the heavy lifting while they went on living. That's really what this comes down to. At the income level where most people live, where the rent or mortgage is real, where the grocery bill keeps climbing, where the kids need things and the car needs things and the house needs things, the advice that works isn't glamorous. It doesn't involve spreadsheets with 17 tabs or aggressive savings rates that would require giving up everything enjoyable. It involves accepting that your income is not the problem and your willpower is not the solution. The problem is that money at this level is under constant, quiet pressure from every direction. And the solution is a handful of automatic structures that protect a small slice of every paycheck before that pressure has a chance to claim it. If you can do that, not perfectly, not dramatically, just consistently, you create something that no amount of financial content can give you, which is options. The option to handle an emergency without borrowing. The option to leave a job that's making you miserable. The option to say yes to your kid's field trip without checking your balance first. The option to sleep on a Sunday night without dreading Monday for financial reasons. That's not wealth. That's stability. And for most households in this country, stability is the most underrated financial achievement there is.